NVIDIA jumped 3%. Lab scores at 61 out of 100. Buy. Demand is shifting rapidly toward their massive GB200 NVL72 architectures. This rack-scale system integrates 72 GPUs and 36 CPUs with liquid cooling to solve unprecedented thermal constraints. Our full teardown reveals how this complex hardware transition will secretly supercharge their long-term data center margins. NVIDIA's hardware dominance is hitting a physical wall because TSMC's CoWoS chip-on-wafer-on-substrate with local silicon interconnect, the packaging technology that stitches multiple silicon dies together, is bottlenecking Blackwell B200 production yields below 70%. While Wall Street celebrates the Blackwell launch, the engineering reality is a massive packaging bottleneck. The B200 utilizes a dual-die architecture, squeezing two physical chips onto a single package, pushing the reticle limit, the physical size limit of a single photolithographic exposure. This design demands an unprecedented 10 terabytes per second of high-bandwidth memory interface speed. By comparison, AMD's MI300X, Advanced Micro Devices' flagship AI accelerator, uses a different packaging approach that avoids these specific dual-die yield issues, but lacks NVIDIA's software integration. This packaging friction means hyperscalers cannot get Blackwell systems in volume, forcing them to rely on older Hopper architectures. Additionally, recent research reveals that NVIDIA's flagship Edge AI hardware cannot support process-level energy attribution, the ability to track power consumption down to individual software processes, exposing an efficiency blind spot. Despite these physical limits, buyers are desperate, bidding up the stock 2.95% today to $210.69. The market is ignoring the packaging yield constraints because demand remains completely inelastic. But as custom ASICs, application-specific integrated circuits designed for a single task, from Google and Amazon scale, any prolonging of TSMC's packaging bottleneck will erode NVIDIA's market share. Today's upward move is a temporary reprieve from these hard silicon constraints. Quarterly financials showing modest revenue momentum for NVIDIA. By fourth quarter 2026, the convergence of protectionist trade policy and sticky inflation will compress NVIDIA's gross margins by 300 basis points as supply chain friction intensifies. The macro environment is no longer a passive backdrop. It is a violent wave of economic nationalism. While TSMC's May 2026 revenue of 417 billion new Taiwan dollars, roughly $13 billion US dollars, signals robust near-term demand, the Federal Reserve's interest rate rigidity at 3.63% keeps capital costs high. This monetary pressure, paired with a normalizing yield spread of plus 0.29% and an 8% recession risk, threatens capital-intensive tech expansions. Furthermore, looming tariff uncertainty acts as a massive friction point, threatening to disrupt imports of critical semiconductor manufacturing equipment and raw materials. This domestic policy friction collides with severe geopolitical choke points. Strict export controls already block NVIDIA from shipping high-margin H100 and H200 accelerators to Chinese hyperscalers, massive cloud computing providers operating warehouse-scale data centers, forcing a pivot to lower-margin, compliant H20 alternatives. With TSMC's advanced packaging concentrated entirely in Taiwan, any cross-strait escalation instantly halts the Blackwell supply chain. Simultaneously, geopolitical instability in Iran accelerates the global shift toward a national security-first economy. This transition favors defense giants like Lockheed Martin over pure-play commercial tech. As inflation remains sticky with CPI at 0.6% YOY and unemployment at 4.3%, the macro wave is shifting from speculative growth to defensive infrastructure. Investors buying today's 2.95% rise are ignoring this structural stagflationary bottleneck. NVIDIA reported earnings per share of $1.87, beating the Wall Street estimate of $1.79 by 4.3%, a solid beat that signals strong execution. NVIDIA Compute is trading below its 20-day average. At 200, the mid-70s margin target isn't a floor. It's a ceiling. Management script, We will work to hold our gross margins in the mid-70s. 3 words: work to hold. Repeat every quarter. That's not guidance. That's a warning. Memory costs, CoWS yield, and tariffs are already inside the P&L. The PR machine wants you watching the finish line. The lab sees the hurdles. What NVIDIA is saying, we're holding margins. What the lab hears, we're fighting physics. Insiders dumped 1.02 million shares in 90 days. That's not noise. That's a signal. Executives trade on data, not hope. When they sell this hard, they're pricing in a margin reset or a supply chain choke point. EPS beat by 4.3% for straight quarters of upside. But R&D hit $18.5 billion, 8.6% of revenue, up 43% YOY. That's not scaling. That's survival. NVIDIA is outspending Qualcomm's $10 billion tens torrent bet and AMD's MI400 ramp to stay ahead. Blackwell's N3E node is slipping. HBM3E bandwidth is maxed out. Cost improvements won't change the laws of semiconductor physics. The momentum breakdown for NVIDIA. RSI sits at 49, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. NVIDIA's bull case rests on the insatiable demand for its Blackwell B200 platform and the rapid transition to liquid-cooled, multi-die GB200 NVL72 architectures, rack-scale systems combining 72 graphics processing units and 36 central processing units. This hardware integration cements NVIDIA's position as the primary compute engine for generative AI, driving massive near-term cloud spending. But here's what breaks the bull thesis. Strict U.S. export controls force NVIDIA to ship lower-margin H20 alternatives to China, while TSMC packaging yield delays could completely stall system-level deployments. Furthermore, with advanced packaging concentrated in Taiwan, any geopolitical disruption threatens the entire Blackwell supply chain, exposing investors to single-source failure. How will NVIDIA maintain its 80% gross margins when hyperscalers scale custom ASICs? The lab's answer is that they cannot. Software moats like CUDA, Compute Unified Device Architecture, NVIDIA's proprietary parallel computing platform, are increasingly bypassed by open-source compilers like AMD's ROCm, Radeon Open Compute, AMD software stack for GPU programming. This software equalization forces NVIDIA to compete on raw hardware pricing. Our June 16th buy call at $207.41 is currently up 1.6% at today's price of $210.69, validating our near-term technical setup. If Blackwell ships without thermal delays by Q3 2026, expect a breakout past resistance to $224.10. If packaging yield failures persist, the stock will plunge to support at $200.42. The lab's AI score of 61 out of 100 signals moderate conviction that the production ramp will succeed, making the bullish path more likely. Here's the macro picture shaping NVIDIA. Strict U.S. export controls on advanced silicon restrict NVIDIA from shipping its flagship H100 and H200 accelerators to Chinese hyperscalers, forcing the deployment of lower-margin, compliant alternatives like the H20 and L20. Meanwhile, the concentration of TSMC's advanced packaging facilities in Taiwan exposes NVIDIA's entire Blackwell supply chain to severe geopolitical and cross-strait disruption risks. The insatiable demand for generative AI infrastructure is driving massive adoption of NVIDIA's Blackwell B200 platform, which relies heavily on ultra-fast high-bandwidth memory and TSMC's CoWS packaging. As physical scaling limits loom, the industry is shifting toward liquid-cooled, multi-die architectures like the GB200 NVL72 to sustain performance scaling. The primary near-term upside catalyst is the rapid production ramp and initial shipment volume of the Blackwell architecture to major cloud service providers like Microsoft and AWS. Conversely, the most critical downside risk is a potential delay in packaging yields or thermal management components that could stall system-level deployments. NVDA's 61-point buy score signals a decisive upside catalyst today. Where do you see NVIDIA in 30 days? Up, down, or flat? Drop your call. We're not giving financial advice. This content is purely educational, and you should conduct your own due diligence because past performance does not guarantee future results and market conditions can change rapidly. We also recommend reviewing the 10Q risk factors and macro trends before acting. Subscribe now for deeper engineering insights you won't find elsewhere. If you want our full breakdown on Cerberus, the link is in the description. Stay sharp and see you next time.